start that right now. This event will be recorded for archival purposes. Auto-generated captions are available. Simply click CC at the bottom of your screen and choose Show Subtitles. Microphones are currently muted. Please submit questions through the chat. If you run into any technical issues, you can send a message to me through the chat and I will do my best to help. And now I will turn things over, and I just need to say that I was asked to say this. I will turn things over to the fake Charlie Merrill from the great class of 1971. There we go, Charlie.
Thank you very much. And welcome everybody. I am speaking to you from my apartment in New York City, and Wynn is, I believe, looks like his living room up in Vermont. This is a auspicious occasion for me because I've been waiting 55 years to have my licks at Wynn. After we spent a summer working for an organization, which is another story, but that summer he was training for soccer, and we spent hours in the afternoon where I was the goalie and he just kicked soccer balls at me. So today I'm going to return the favor and hopefully kick some verbal questions to Wynn about his book and about Merrill Lynch and about his career at that firm. In the interest of full disclosure, I also worked at the firm from 1990 through 2002. And I also worked the last year in Wynn's division in the International Private Client Group. As many of you know, Wynn went to work for Merrill Lynch right after his internship, well, actually right after business school in 1974. And his father, of course, is the Smith of Merrill Lynch, Pierce Fenner and Smith, and one of the founders of the renewed Merrill Lynch in the 40s. Wynn ultimately became the executive vice president of Merrill Lynch & Co., member of the executive committee, and led Merrill Lynch's International Private Client Group, which was one of the largest private wealth management globally in the world at that time. He retired from Merrill Lynch in January of 22, based on the radical turn on leadership in the firm, which is something that we will talk about. And he could not agree in the future direction of the firm. When, and as you know, Merrill Lynch ended up in a critical situation during the financial crisis of 2008, was acquired in a last-minute deal by Bank of America, and it continues today as a, quote, subsidiary of Bank of America, even though the brand is still Merrill Lynch. Actually, oddly enough, it's called Merrill now, formally. When at that time, at the final shareholders meeting that approved that acquisition, delivered a now very famous address, which has been published widely, basically blaming the board of directors and specifically the former CEO of destroying the culture and values of Merrill Lynch's success. As you know, Wynn then left the firm, acquired Sugarbush up in Vermont, turned it into one of the great resorts, ski resorts, and actually around and a hell of a golf course, and has recently left that post. And I think when you told me however, you still have skied over 140 days. Is that about where you are?
Only 116 this year, Charlie.
116. Anyway, so enough about Wynn. Our role today is to discuss, essentially using Merrill Lynch as an example, is to discuss how leadership, corporate culture, and corporate loyalty help drive the success of a firm And when those cultural corporate values are not followed or not enforced or not part of the day-to-day relationship with that firm's clients, how those firms can suffer the disaster that almost happened to Merrill Lynch. First of all, Merrill Lynch has had an extraordinary connection with Amherst College in many levels, many of the founders, the individuals through the years. Maybe you could just give us a quick history of the Amherst connection with Merrill Lynch.
Sure, Charlie. It's quite a connection. It all starts, of course, with Charlie Merrill. And he was really a very interesting young person. He grew up in Glen Florida, to a country doctor that was, not that successful, really had a tough time. His mother had a great influence in his life, and she felt that he needed a better education. So she actually managed to send him on scholarship up to Worcester Academy for a prep year before heading off to college. And he didn't do very well there academically. He had disciplinary problems. And they did something actually unusual. They said they would not grant him a degree unless he finished his first year in college successfully, and then he would get a degree ex post facto. So somehow he managed to get into Amherst College, and he went up there, and again, was not a great student, but was a charming, handsome young man, a bon vivant. He was really on scholarship. He worked waiting tables at Kaisai, he raked leaves, he sold suits for a local suits manufacturer, but he only remained at Amherst for 2 years. So he left in 2000 and he left in 2006. He would have been the class of, 1906. He would have been the class of 1908.
Right.
And then he went off to the University of Michigan, spent a couple of years there, never graduated. And his girlfriend, who became his fiance from Smith College, actually had her father hire him, and he began his first career at Sorstrom and Company in New York City. Well, he actually did pretty well there. He went on to work for a company called Burr, and in 1914, he started his own one-man shop, which was called Charles Merrill and Company. And it was interesting because there were a number of people who were really Amherst people. Sumner Cobb was his roommate. There were a number of people that came in over the years. And my own father graduated from Amherst in 1916. And he went to Boston to interview, was given no time at all, came down to New York and was interviewed by a company called Bondbright and hired, and they said they would pay him a good living wage. When he opened up his paycheck that first week, it was $7 a week. So he was quite aghast
That's right.
what a living wage was in those days. So then he was actually ran into an Amherst classmate named Brooks Johnson, who said he was working at this new startup company called Merrill, and he was getting paid $10 a week. So my father went over there and interviewed and got a job and began working on September 1st of 1916. And then a couple of weeks later, he was doing some work on the floor, and a man came up and looked at him and he said, "Are you Win Smith?" And he said, "I am." He said, "Well, I'm Charlie Merrill. Welcome to the firm." And he said, "By the way," he said, "why don't you join me and we'll go up and see the Amherst Williams game." So that actually began in 1916, a friendship, a partnership, a really special relationship that all began, probably because of that Amherst connection. Now, over the years, there were a number of partners. Pop Melcher came in. He was a partner of the firm for many years. There was a fellow named Doug Milne, who was a partner of Merrill Lynch. And then very interestingly, a fellow named Harold Johnson, who was the class of 1918 at Amherst. He was an international lawyer. He was a limited partner of the partnership, meaning he had a financial stake but no management responsibility. And he actually became a little bit of a thorn in the side of my father when they wanted to incorporate in 1958. His share was going to be a little bit, so he held out. And the final negotiation with Harold was he would agree to the formation of the corporation if Merrill Lynch donated $50,000 to Amherst College, which they did. So in those days, that was a decent amount of money. And of course, later on, there was a great connection with George Shinn, who joined Merrill Lynch in 1946 in our training class number 2. And he rose up the ranks, and he and Don Regan really slugged it out to see who would be the successor to Mike McCarthy. Don Regan won out. George became president for a couple of years and then was recruited by First Boston to go over there and become CEO, which he did and very successfully. And as I think many people know, George was chair of the board of trustees of Amherst College. So those are just some of the connections, but they're really good ones. And over the years, there have been many people like Charlie that joined Merrill, Chuck Lewis, who's been very influential in the development and fundraising of Amherst over the years. My own son-in-law is now there. But in the early days, it was really a tight connection, and it really formed that great partnership and friendship that Charlie and my father had, the connection to Amherst College.
Yeah, so when you read a little bit of the history of Merrill Lynch, it actually started out with when Charlie Merrill first started practicing. It was more of an investment banking firm. And ultimately, when the 29 crash came around, how did Charlie Merrill handle that? And ultimately, how did the firm survive the depression and financial crisis of the 30s?
Well, Charlie, in those early days, Merrill became Merrill Lynch when Eddie Lynch joined in 1915. And that became the first Merrill Lynch. There was actually a comma between the names because they were two different people. And Charlie had learned a lot about the growing retail business in the United States. He got enamored by it. He realized there was great opportunity. And so the first break that came for the early company in 1950 was underwriting a stock offering for McCrory stores. And that really gave them their first leg up. One thing they did in those days too is they took consideration by taking shares in the companies they underwrote and not just cash. That was a philosophy he had, a very successful one. And he grew that expertise. So by 1926, which was 12 years after they started the firm, he underwrote a total of 16 issues for stores that totaled in those days $590 million, and they had a 50% market share of retail store offerings. So that was their early success. They also became private investors, much like a private equity firm, in a number of different ventures. Eddie Lynch, for instance, got enamored about the movie business, and they bought Pathé and Company, which produced The Perils of Pauline, as one example in the silent film days. They sold that in 1926 for $2.9 million, and Charlie reinvested the proceeds in Safeway stores out in California that then merged with Skaggs and then grew the stores from about 600 to about 2,600 by 1929. And as you can recall from history, those were the roaring 20s. The stock market was booming, and people were saying the most dangerous words in investing is this time it's different. The market is not going to correct. But Charlie had a premonition that this was really a market that was overspeculated, that people were far too much leveraged. His own firm was far too leveraged. And so he tried to convince his partners that this was the time to really deleverage. He talked to clients about deleverage, raising cash, and nobody actually believed him. So he began to lose confidence and actually went to a psychiatrist. And after a couple of sessions, the psychiatrist turned to Charlie and said, "Charlie, you're not crazy." He said, "I've liquidated my positions. I believe everything you're saying." So that gave him the confidence to go back. And Merrill Lynch actually did get themselves in a very strong financial position before the crash of 29. So when the crash happened, Merrill and his clients actually fared far better than almost anybody else on the street at that time.
And then when did the firm really turn to the Wall Street to Main Street that was always the byline of the firm?
Yeah. Well, Charlie, after 29, decided that the securities business, the brokerage business, was not one he wanted to be in. So he actually sold his firm to E.A. Pierce, which was a large wirehouse in Chicago. And most of the people and partners, including my father, went to work for E.A. Pierce in Chicago. And for a decade, that's how they survived. They worked. They managed to get by. They didn't make a lot of money. But in 1939, my father was very concerned that the partners were not going to re-up in the partnership. And as you know, a partnership, you really have to have the partners agreeing to putting their capital back into the business. So he called Charlie Merrill, who he'd stayed in close contact with, and he said, "I think there's an opportunity of you coming back into the business, us taking a very different approach to the business." Charlie was intrigued. He took the train out to Chicago. He saw my dad's business plan. And then for the next several months, they went back and forth, back and forth. Merrill asked for more analysis, more detail. He brought in a colleague of his and his son-in-law Robert McGowan, they went over the numbers and they came up with a different approach, which was really bringing Wall Street to Main Street. And the reason they did that is they looked at the world. And even though the world was in crisis, about to enter World War II, they saw that there was an opportunity of really doing securities business very differently, about not just catering to the very wealthy, but by making Wall Street available to the average middle-class person around the country. But things had to change. They had to change the business plan, the dynamics, and that's what they came upon, the strategy that they launched in 1940 under the new firm, which was called Merrill Lynch E.A. Pierce and Cassatt for 1 year. And a year later, when they bought Fenner and Bean, it became Merrill Lynch Pierce, Fenner and Bean.
And when did they add your father's name to?
He was added in 1958, and he was added because young Alf Bean was not appointed as my father's successor. My father appointed somebody named Mike McCarthy, which he was very upset about and said he was leaving and he would sell his name to the firm. And unbeknownst to my father, the partners voted to replace Bean with the name Smith, which was quite a surprise to him. But he had been the managing partner at that time from 1940 up to that period of time.
Right. So during the post-war period, Merrill developed a significant corporate culture, and they had essentially basic principles about how to respect clients, how to manage clients, and how to maintain corporate integrity. Could you talk a little bit about the corporate culture that evolved and really existed up until the time of the crisis in the in 2008?
Yeah. Well, Charlie, as you know, the tone is always set at the top, and the tone was set by Charlie Merrill at a very young age. Even when he was a young kid, before he started his own firm, he wrote an article in a magazine called Leslie's Illustrated Weekly, and he talked about the rights of clients. And that was not something that people really cared much about in 1911 in the speculative market, but he really felt that clients had to be treated first. Their clients' interest had to come first. And he really practiced that. There are wonderful memos that I saw in writing the book that he wrote internally to people, basically saying, you get no credit if you hype a sale. You really have to do the right thing for clients. And that set the tone way back in 1914 when he started his firm, and it carried forward. So when the firm started, again, recreated in 1940, they had a series of basically 9 principles, 9 guiding principles. And the first one was the client's interest must always come first. And that was paramount to everything he did. It was paramount to everything my father did. And that was really passed along through generations of leaders. And, you know, you can say something, but it's really how you walk the talk that makes the difference. But it was really embedded upon us. The other principles that were really key to them, Charlie, was they realized that their main assets were their people and their colleagues. And if they didn't treat them with respect, if they didn't treat them in a caring way, if they didn't look after them when they got into trouble, they really weren't going to have a firm. And that was what really led Merrill to be called Mother Merrill. It felt like a family to people, even when we grew to 72,000 employees. Charlie Merrill also had a real sense of obligation. He grew up poor. He became a very wealthy person in the 1920s, but he was really a philanthropist. He always gave back to the communities. And he believed that Merrill really had to be part of a community and not just take profits from it, but really had to be part of it. So that was a third principle. Client's interest is respect for their people, is respect for the community. And then he also realized that a partnership had to be a teamwork. And I think one of my father's great skills, where Charlie was the visionary, was really bringing a team together, making people operate as a team. That was the fourth principle. And the fifth was operating with integrity. And I remember many of the leaders always saying to me, you can't read about it on the front page of the Wall Street Journal tomorrow, don't do it. You know, admit when you're wrong, do the right thing, and things will turn out right. And over the years, those 5 principles became embedded in our culture. And the way cultures happen and the way cultures survive is they survive through storytelling. So that was one of the reasons I wanted to write the book, was to really tell the story through the leaders over the years to help people understand how that culture came to be, how special it was, and how it really allowed us to survive. Because everybody makes mistakes. We made mistakes as a firm. We did wrong things. But it really is a question of, do you have a North Star to come back to it? And those principles and that culture, I think, allowed us to come back.
So give an example then of a mistake. Give an example of something where this very noble sounding firm actually did make a mistake. Clients may have been hurt. And what kind of accountability did accrue to those people that actually made those decisions?
I can remember probably one that maybe was the biggest mistake we made in the 1980s. We had a client called Baldwin United, that some people may remember. And Baldwin United was selling annuities through broker dealers. And these were high yielding annuities. They were sold to probably the most vulnerable of clients, older retired people that really were looking for fixed income. And it was very attractive because it paid a high rate of interest. Well, Baldwin was a bit of a shell game, and basically their annuities became worthless. They had sold 3.7 billion through various broker dealers and 700 million through Merrill Lynch. So Merrill was under no obligation to make the clients whole. This was not their mistake. Perhaps they should have done better due diligence. But at the time, Roger Burke, the chairman, who had followed Don Regan, made the very conscious decision that if we really believed in putting the client's interests first, we had to do something to correct this. So he really put together, the street. He led the street, and together didn't entirely reimburse the clients for losses, but I'd say reimbursed them to a very great extent. And he did that knowing that it was going to be an after-tax write-off of $83 million, which in those days was big money. And it was going to result in the loss for the quarter of $52 million. Now that was significant because Merrill had never lost money in any quarter since 1940. One of the very few Wall Street firms who could have said that, and that was a record they were very proud of and we were very proud of. But Roger realized that if we were going to do the right thing, have the client's interest in mind, we had to make the clients whole, even if it meant losing money in that particular quarter. And I would say the reaction internally was fabulous. People really appreciated it, and I think the stock market understood it, and everybody had great respect for Roger Burke for doing the right thing.
So Merrill Lynch went through an extraordinary growth period, particularly in the 90s and into the 2000s. Stock price, would go up, it would split, it would go up again, would split again. It weathered the dot-com bust in the late 1990s. And then things began to really change when the board decided to hire Stan O'Neill as the president. In your book, which leads up to really I think part of the last few chapters of your book about Stan O'Neill, the kind of person he was, the how he changed the culture, I think is really the heart of what we want to talk about today, because this is where even the leadership of a great firm ultimately affects how the firm survives. In your book, you quote Lonnie Steffens, who was the head of Merrill Lynch Private Client and executive vice president, who said that for 50 years, there was not an opportunity that Merrill Lynch didn't seize. We had different leaders with different styles and faced new and challenging environments, but I firmly believe it was the unique culture and strong culture that made the difference. So the firm did have to adapt to different market conditions. The firm became a major capital markets player in the 80s, and that's a different game. That's not the private client, Mother Merrill, and the folks that ran that business may not have been as supportive maybe of that Mother Merrill culture. So how did that grow, and then ultimately, what decisions did Stan O'Neill make that caused this radical change in culture?
But Charlie, you mentioned that we grew very rapidly in the 80s and 90s, which we did. And I credit Dan Tully, who was the president for 8 years and then CEO after that for another 4 years. So those 12 years where he was really, the chief operating officer, to really maintaining that culture. One of the things he did is he knew we were growing. We were growing not only organically, but we were growing through acquisition. And he codified those principles we talked about. He put these little cubes together. And basically, if you can see those, it's the client's interest, teamwork, response, respect for the individual, et cetera. They hung in every single office in the world, in English as well as in the local language. He talked about it all the time. He used to have executive meetings, and I can remember many times where a decision would come along and he would turn around and he'd say, is that in the client's best interest? And that was just something that cumulatively over time got embedded in all parts of the organization, whether they were traditional private wealth or trading or investment banking. Now, it wasn't easy, but it was hard work over time. It was that cumulative effect, Charlie, that I think allowed that culture to really maintain itself. The firm was a very different firm in 2000 than it was in 1940. Right. Very different. We were a major investment banking firm, a major trading firm, a major asset management firm, international private client as well as domestic private client. But he took the point of view, as did all the leaders, that there was one culture, regardless of where you were in the world or where you were in the particular part of the firm. Bill McNitt wrote a question I just saw is, how did you maintain that culture growing to 72,000 people? It wasn't easy, but people felt that they had access. They had a voice. There were gatherings together. One of the things that Bill Schreier did, which I thought was great, is he actually would have every other year a meeting between the retired partners and the executive committee of Merrill Lynch, the executive managers. So they would learn about what we were doing, but we would also learn about what they had done. And that link, I think, was a very important part of keeping that culture together over the years, even as we grew and became far more global.
Yeah, and I remember my time there with the training sessions down at the big Princeton Training Center, and actually just outside of Princeton. And it was, despite the fact that the local pub in the training center was one of the great places for getting to know all of your colleagues, the actual training sessions reinforced that culture across all multiple disciplines and across all levels of corporate structure, both management and financial consultants. So tell me, what is it that Stan O'Neill did or didn't do and his leadership team that so radically changed the culture? Because your book describes or actually sets forth various witnesses, if you will, or people who knew the folks that were running Merrill Lynch in the early 2000s. And all of them mention at various times how quickly the culture changed and how inaccessible, if you will, the leadership team was to the rank and file in the firm.
Well, let me set the stage, Charlie, for what the firm was in 2000 when he took over, because it's important to understand the fact and not the story that he told. So when the calendar year ended in 2000, we'd had record earnings of $3.8 billion. That was a lot in those days, maybe even today. Our pre-tax margin was 21.3%, and our return on equity was 24.2%. We'd had 48 consecutive quarters where we had led the global underwriting league tables in debt and in equity. And I will say parenthetically, with one exception, we made a conscious decision not to be a leader in mortgage-backed securities. We'll come back to that. We had a 13.3% market share of all global underwritings. We were number one in research. We were the number one secondary equity trader. We had a private client organization that had $1.5 trillion of client assets. We had an asset management company that had $538 billion of assets under management. And I mentioned we had 72,000 employees, 21,000 financial advisors, over 900 offices in 44 countries, and the stock had hit an all-time high of 80. So that's what the company looked like at the end of 2000. What Stan O'Neill and his compatriots started to do was to basically say that the company was not in good shape and needed a change. They began to spend a tale about how Dave Kamansky, the CEO, had overexpanded, we'd gotten fat, we'd become paternalistic, we were losing our way, we needed a change. So they began to spread that story based on what I think were false stories at the time. So Stan was named president in July of 2001 and quickly moved to eliminate Dave Kamansky. And he did that really through a cabal of a few people within the company, including one of the directors. And they managed to basically move Dave out, and Stan became chairman and CEO. For whatever reason, Stan never wanted to understand the history of the firm. He did not appreciate the culture, and he really publicly degraded the culture. He used to refer to Mother Merrill as something that was bloated, that was paternalistic, that was nepotistic, and that really wasn't the firm that it should be in the future. He cut out thousands of years of experience of not just people like me, but people in managerial roles throughout the firm. He cut costs significantly. He cut back on areas that take decades to grow. And that cost cutting initially worked well to the bottom line. It looked good. He was earning more money. But then he realized that we weren't growing the top line. We cut out many areas I had told you. So he then decided that he would use what was a very strong balance sheet and start to leverage it and start to get into trading operations, which really had been more of a successful strategy of firms like Goldman and Solomon and other people. By the time 2007 came along, he had loaded up our balance sheet with about $50 billion of CDOs that cannot be moved. He had taken our leverage ratio from 12-1 to 36-1, which was just remarkable leverage. And there's some fault that has to go to regulators here too, but also certainly to the management and the board of directors. He really started talking about counterparties instead of clients. So the whole culture of the firm was really changing at the time. He also isolated himself, and these were not things that I wrote from personal observation, even though I knew it, but these were where I used third-party people to say he did not listen. The head of mortgage-backed trading actually came to him, a fellow named Jeff Kronthal, and told him to wind down, to deleverage. This is how he made his money. He wanted to actually reduce his business. Stan O'Neill fired him, put somebody else in charge, and they continued to grow that business. So he wasn't listening. He wasn't communicating. He was isolated. So therefore, the firm got into a position where it became really probably the biggest exposed firm in CDOs and prime mortgages in 2007. It all exploded, as you know. Merrill had to write off $8.3 billion in 2000. O'Neill was let go and shockingly was paid $160 million of severance because the board allowed him to retire instead of firing him. And that vested all of his securities, which was pretty shocking to me and many other people. So John Thain came in, and John Thain in 1 year raised over $50 billion of equity trying to save Merrill Lynch, but that wasn't even enough because of the damage that O'Neill and his counterparties had done leading up to 2007. So that's a lot, Charlie, but what it really says is a person came in, did not understand what Merrill Lynch was good at, did not understand the culture, did not understand, the values, isolated himself from any feedback, and led the firm really down a path of disaster.
So why wasn't there any accountability to that? I mean, everybody knew what was going on. In your book, you quote James Kremer's article where he says something, I guess you have to lose $8 billion before you even get fired, but then you get a pay package to leave the firm. I mean,
you're so right, Charlie. There's the question in the chat box about that.
Can I just finish the question? I mean, that's what we're here for. So, no, I mean, you look at some of your predecessors, Don Regan, for example, I've read, he would have just said, fire the guy. It's not because he wasn't part of the Merrill Lynch culture, but when somebody screws up like that, as the leader, and he is ultimately accountable to shareholders, and there were thousands of Merrill Lynch shareholders, employees, who didn't sell their stock because, you know, nobody could believe that the firm would actually, you know, go bankrupt. So it seems to me that that gross negligence in leadership, the board didn't hold him accountable. Your fellow colleagues didn't hold him accountable ultimately. I know he's sort of in exile on half a dozen golf courses up in Westchester, but he's a wealthy man.
You know, the accountability, Charlie, is spot on. I think Bill McNitch just wrote in the chat room, you know, where was the board of directors? And that was a good question.
Thank you.
A shocking comment. Dan Tully had actually called a couple of the directors when Stan was president before he became CEO, and was trying to convince him that they had made a mistake and that he should not become the CEO. And one director said to him, quote, Dan, I can't do that. This is my highest pay that I'm receiving from any job I have. This was the CEO of another company. And so that just shows you that I think some directors were valuing their job more than they were valuing the pay more than they were taking responsibility for their job. CEOs can be very good at presenting facts. And if you don't have a board that is really smart enough, inquisitive enough, pushing back enough, there can be a lot of smoke blown for a period of time. Now, in fairness to the board at the time that the firm unraveled in 2008, there was only one director who had been on the board when Stan O'Neill was appointed. All the other directors were new. And if you looked at the board, in my opinion, many of them were good people, successful people, but they came with backgrounds where I don't think they even knew how to ask the right question. They didn't know what a second derivative was, what a CDO was. They weren't really experienced enough to really probe and to push as hard as they might have, as hard as they should have. How did that occur? Well, I think Stan O'Neill put together his own board. And too often that happens where boards are put together by the CEO as opposed to shareholders. I do think that is changing in the world today, but I think that was really one cause and effect of why there was not the right accountability, you know, in those 6 short years where the firm went from record earnings and a record to demise. And it was only 6 years.
Yeah, that is true. So we've got a few minutes left. 2 final questions, really. One is, what was the story with Ken Lewis and Bank of America, and how did they, you know, how did they fortunately came to pick up Merrill? And secondly, the firm is obviously, you know, has come back. It is now a very strong private client, particularly the Merrill Lynch private client side, is, even though they sold off your old business, the domestic private client business is very strong. So how did Ken Lewis get involved, and what do you think it is what resilience do you see, especially on the part of 12,000 financial consultants today, that has, I think, restored some of the culture that you've talked about?
Yeah, I don't think it was really Ken Lewis, Charlie, because he didn't last very long.
Yeah,
you know,
that's
Brian
true.
Moynihan,
I was at Bank of America at the time, and
you remember that. But
everybody
Brian
said he
Moynihan-
just wanted to buy Merrill Lynch.
Right. But, you know, Brian Moynihan came in, and I have to say, I think he's done a good job. It took him a while to, you know, to sort out the trading balance sheet issues that he inherited from Merrill, to sort out the really problematical loan portfolio he got from Countrywide. But he's done a good job. You know, he's recapitalized the firm. The balance sheet is strong. And then I'd certainly give him credit. He's put a fellow in charge of private wealth by the name of Andy Sieg. And Andy Sieg came from the Merrill Lynch that I knew. Andy Sieg believed in the principles. He believed in the history. He stayed connected to all the former partners. He's asked me to speak to Merrill Lynch scores of times around the country, which I have. Just recently, yesterday, for a group of 200 market executives. And what he wants is, he wants those people to understand the history. He wants them to understand the legacy. He wants to understand the principles. He talks about the 5 principles right now. So Merrill is not the same as it was 20 years ago. It's owned by a bank. It's different. But I would say that Andy is really doing a great job of restoring the culture, keeping the principles alive. And you can see in the results they had last quarter, they had really great results. They're up to $3 trillion of client assets under management. They brought in over $50 billion of new client assets last quarter. And I do attribute that to Andy building a team. Now, not everybody likes it. Not everybody likes being part of a bank, owned by a bank. There's tremendous competition for good advisors out there. But my observation is he's doing as good a job as he can in keeping the good values and keeping the culture, but also growing it for the future.
And so how do you catch lightning in a bottle?
Well, the story of that, we were at a reunion back in about 2008 or 9, I think it was. And there's a group of people that we get together every other year for 2 days of golf. And a fellow named, I probably shouldn't say the name because I don't want to attribute it. But anyway, he ran our equity division for a number of years. And he wrote a thank you note to the organizer. And he said, it was great being together again. He said, every time I get together with my colleagues at Merrill Lynch, I remember how wonderful the days were that we were there. It was like catching lightning in a bottle. And when he wrote that, I said, bingo, that's a great title for my book. So that's how it came about, Catching Lightning in a Bottle. It was the sense and the feeling that we all had, the pride we had of working for Merrill in the years that we did.
Yeah, indeed. Okay, thank you, Win.
You're welcome, Charles.
Appreciate your candor and historical perspective. I think the same could be said as we look back 50 years of Amherst College and hopefully tell stories that that created the culture when we were there. There's a bunch of questions here. Tracy, how do you want to handle that? I see, did Charlie Merrill's estate donate money to the Science Center?
Yeah, thank you for that question, because Charlie Merrill, Charlie was a millionaire by the time he was 30, and that was a lot of money in the 1920s and 30s. But as I mentioned earlier, he really was a philanthropist. He believed in giving away to institutions, to people. And when he died, almost his entire estate went to the Charles Merrill Foundation or other organizations. He was very generous to Amherst because he was very appreciative of Amherst, even though he was only there for 2 years. So Betsy is here, but I believe Betsy, he was the primary, or the Merrill Foundation was the primary donor for the Merrill Science Center. He built 3 faculty homes, which were located by the old social dorms. He named one after my father, and I forget the other 2. He was very generous to Deerfield Academy, to so many organizations. So he loved Amherst College and was very generous to it over the years. And his own son, James Merrill, the poet, who became poet laureate, was also a graduate of Amherst College.
And there's another note here following up on your comments about Harold Johnson and how he donated money to start Hampshire College. And they wanted to name the college after him, but instead he deferred to just have the library, the Harold Johnson.
He did. Even though I think he was kind of irritated that his partnership was being converted into corporate shares and he's being diluted, he did okay. Yeah. And so I think what he got from those proceeds may have helped the $6 million he donated to start Hampshire College. And I believe that the founders, and Ellen Longsworth, related to Chuck Longsworth, who was the first president there, I believe they named the library after him. So there's Johnson Library as opposed to Johnson College.
Right. Any other questions in the 2 minutes we have?
Actually, Bob Sparks is asking, is Hampshire College still a viable institution? I know they are having some struggles, so I don't know the answer to that, Bob, but I do know that they had some struggles in recent years. If you remember, when we were in college, you could actually go to Hampshire and take a course in kite flying, which I think your sister did, Charlie.
Yes, she majored in kite flying and now runs the business school in University of New Hampshire. So, you know, that's shows you what kite flying can do for you. Any Any other questions, comments?
Charlie, I have a question.
Yes, sir.
Charlie, are you related to the founder?
No, no. And I have gone back.
I was
I am.
sure.
I know, and so did everybody I worked with at Merrill. Kept saying, and I finally, I just gave up. I would just not. I would never claim to be the delinquent grandson of the founder of Merrill Lynch. But I have gone back on Ancestry many times and just cannot find the link, because most Merrills in this country came from one fellow way back in the late 17th century. So we'll see.
When where did O'Neill come from? What was his previous job?
He was at General Motors, and he was
Right.
hired into Merrill Lynch, actually into the treasurer's office initially, when we had a treasurer that came from General Motors. He then moved down to investment banking, where he was in the high yield department. And very honestly, and I am not saying this, this was the feedback from the head of investment banking, considered average, not considered a great investment banker. He left 3 times and he was rehired back. And the head of investment banking, Barry Freeberg, rued the day. He said that he didn't just let him go. But he really came from a very different background. And he was at Merrill for, probably 15 years before he became CEO. But he just, as I say, never embraced the culture, frankly, gave a damn about it, or even wanted to understand it.
Yeah.
Now, for those of you who are either financial people or lawyers on the call, I will probably insult you, because Don Regan said to Dan Tully when he left and retired and went to become Secretary of Treasury, he said, never let an accountant or a lawyer ever run Merrill Lynch. Now, what he meant by that was Merrill's great strength was sales and marketing. And he really thought it was very important for somebody who was in the client service business to rise up and lead the firm. And that is something that, even though O'Neill was in the investment banking business, it was always on the product manufacturing, never on the relationship side of the business.
Who was hurt by Merrill's troubles? Was it, I'm gonna kind of assume it wasn't the wealthy leaders of Merrill. Was the Main Street guy hurt?
Oh, it was everybody. The stock went from 80 to $1.50. And the one thing that we at Merrill, who were veterans there, we never sold our stock. When you became an executive, you were paid, at least 50% in stock. And there was sort of an underlying feeling that you never wanted to sell your stock because it was doing well. And plus, there was a sense of loyalty. Many advisors, many clerks, many people, even the lower levels, participate in our stock purchase plan. So a very significant amount of Merrill stock was actually employee owned. So when the stock crashed, there were people that had planned to retire that couldn't afford to retire. There were people that were worth a lot of money who were worth a lot less money. They were still okay, but there were people who actually had their fortunes wiped out. And then there were the mainstream people who were harmed by the whole financial crisis. And Merrill was, unfortunately, one of the early catalysts in causing the problems of 2007, 2008. So it was very, very broadly spread.
Hey, when pre-Stan O'Neill, it seems that Merrill had great leadership. Can you expand on the firm's succession planning process?
Yes, it was very orderly up to that moment in time. And people were brought along. We actually had an assessment process for branch managers. It was very thorough, it was very detailed. And I remember, one of the things that was really an immediate no is if anybody questioned the ethics or the honesty of a person. If that ever came up, that person never got promoted even into management. So it was very orderly, but we got into this period of time where the firm was growing. And frankly, I didn't see it coming. Most of my colleagues didn't see it coming. And there was just sort of a separate path that O'Neill got into. He was very smart. Now, Stan O'Neill is not a dumb person. He's very smart. He's very well educated. He went to Harvard Business School. He literally read Machiavelli and the Prince. He had that book in his office. He understood Machiavellian techniques, which none of us did. We were too naive. And so up to that point in time, there was a really orderly succession of management. And he actually broke the rules.
When, Peter, there was a gentleman who was a very, very good friend of mine in the town I used to live, which is Rye, New York. Kids grew up together, same club, saw him socially all the time. He was a fairly senior person in the research department at Merrill. And I remember him telling me, I had to dissolve the department, turn out the light, and close the door. And I suspect that had something to do with the O'Neill era. His name was Don Ketchapalia.
Oh, I know Don very well.
Unfortunately, in the past tense now, but anyway.
Oh, no. Okay.
Yeah. But
Great
was
guy,
he
great
was
guy.
he was he a casualty of the O'Neill era?
I believe he was. I forget exactly when Don left. We stayed in contact a few years after that, but yes. And Don was a very smart guy. He really grew up on the fixed income side of research.
Yeah.
But that part of research was really pared down in 2001, 2002, as was the relationship side of the investment banking world, as was private client, as was the international private client world.
And just a second question. You mentioned, and I can't remember what year it was, at some point that Charlie Merrill, the elder, not our esteemed classmate and moderator, and your beloved fraternity brother, grew weary or leery of the brokerage business. Can you explain that a little bit?
Yes. After the crash of 29, he really didn't think it was going to be a great business. He didn't think people were going to be getting back into the stock market. So he decided that his time would be best spent managing his private equity investments. And the largest of them at that point in time, after he sold the Merrill business to E.A. Pierce, was Safeway stores in California.
Yeah.
So for the last 10 years, he was actively and intimately involved in the growth and development of Safeway stores. And a lot of what he learned at Safeway, he brought back into the security business. And that was how to manage a low margin business, how to really bring professional advertising and sales promotion into the business, the value of good management development. So there was a lot that he learned in Safeway that when he came back and started off the new firm with my father in 1940, he incorporated from the decade he had spent managing and running Safeway stores.
Interesting. Thank you.
So there's an interesting question here from Stan Whittemore. Does the cultural change in Merrill Lynch have parallels with the cultural change in the US in general today? And then a follow-up from a listener from class of 90, Kelly Close. Is there any advice this class of 71 has for how the students of Amherst or younger grads who are pursuing building strong organizations? So I guess there's sort of
I think that's a really profound question. And I think there is to some degree. The Wall Street that I knew and I respected, I thought changed quite a bit in the early part of 2000 leading up to 2007 and 8. A number of the firms stopped being led by client people and started being led by traders. And as a result, there was more of a focus on a discussion of counterparty versus client.
right.
The counterparty, by definition, is an adversary. So you're dealing with adversaries instead of clients. And I think that did change the culture. I think there was a greed that got embedded in Wall Street. It's always been greedy to a degree, but I thought it really exacerbated itself. And I think that is reflected to a degree and was to a degree in American culture. And I think that has come back to haunt many people too, when people really look at the 1% now and really think they are all villains, which they are not all villains. But the question of Kelly, I think, is a really good one. And Kelly, I think that what I hope people are realizing right now, and I think they are, is that when you look at leadership and who should be leaders, whether it's the country or a company, is character is really important. Bad character leads to bad results. And too often that was overlooked. Too often a person's technical skills or sales skills, were valued and not a proper examination of character. Not getting political, but my biggest concern with our past president was the lack of character. And I think that sets a terrible tone for the country and for the next generation. So I would say that character is something that really should be examined very carefully before anybody is selected for any position. I also think, as I've talked about the importance of culture in an organization, the right culture really can make an enduring, sustainable company. And a right culture doesn't happen overnight, but it can be destroyed overnight. The right culture happens and is maintained through storytelling and through really emphasizing the importance of a culture.
Ladies and gentlemen, we are at, I believe, the end of our time. Any final thoughts or comments? I was asked to remind you all that at 5:30, our class trivia game begins. So I think that will be very entertaining. But any other final comments?
Yes, thanks a lot for very interesting discussion.
Thank you all for listening. And Charlie, thanks for being so nice to me.
Yeah,
It really is nice to you.
those were softballs, but you're buying the drinks the next time. See you guys.
Bye,
Thank you.
everybody.
Thanks to both of you.
Thanks.
Thank you, Win.
Many.